Hi, and welcome to Russell's Market Week in Review for Friday, Jan 30th, 2026. I'm Rudy Samantha, Global Co-Head of Fixed Income at Russell Investments. It's been a busy week cleaning snow on the East Coast, but in some good news looking ahead, we've got a true coast-to-coast matchup coming up, the Seahawks versus the Patriots. And while most of Russell Investments will be cheering for our hometown team, I'll have to admit I'm excited to have the Pats back in the Super Bowl discussion. Now, turning to markets, looking back over the prior week, four major themes stood out. At the January 28th meeting, the Fed paused its rate cutting cycle with a 10-2 vote. This outcome aligned with the more stable labor market and cooler inflation trends that our chief strategist, Paul Edelman, had highlighted last week. The 30-year Treasury held steady at 4.8%, suggesting markets had largely priced in the pause. More broadly, the yield curve remained steep, with the 2's30 slope at 130 basis points, with the short end now more firmly anchored and the long end reflecting policy risk and ongoing evolution and uncertainty in labor markets, growth, and inflation outcomes. Now, moving on to credit markets, a key dynamic that we're watching is the scale and structure of AI-related CapEx financing. In Q4, four major hyperscalers collectively issued close to $1 trillion in debt, using a mix of traditional investment-grade bonds, special purpose vehicles, hybrid structures, and asset-backed financing. While investment-grade spreads briefly widened into the mid-80s, as investors evaluated this novel issuance, they quickly retraced back to around 70 basis points near historically tight levels. Given the Fed's pause, we may see additional AI-related IG issuance from companies eager to secure funding before financing conditions potentially tighten. As an early signal, Meta beat quarterly revenue expectations yesterday and raised its AI CapEx outlook to $135 billion, above the consensus analyst estimates of around $110 billion. Despite extremely tight spreads, we continue to invest and find opportunity across all sectors of corporate, securitized, and emerging market credit. Credit markets have increasingly become systematized, both in trading and in alpha generation, and using combinations of investment styles that can be both fundamental and quantitative in nature has been especially useful in this environment. Moving to global markets, Paul also noted Japan's evolving fiscal position and the rise in JGB loan rates. This raises the potential reversal of the long-standing negative carry between Japanese and U.S. yields. If this trend continues, inflows into JGBs could be accompanied by outflows from U.S. Treasuries, which we are monitoring closely. Overall, though, we view this more broadly through the context of opportunity and some divergence across major developed market rates. As we noted, pauses from the Fed and earlier from the ECB, combined with pauses from Bank of Canada recently and potentially rising trend in the Bank of Japan, you can start to see relative value opportunities in rates markets. Pair this with variations in steepening, flattening, and potential inflation and growth outcomes, and we and our managers in the global rate space are now able to find more consistent relative value trades from a long tenure of very low and then very consistently rising rate environment. And last but certainly not least, our view on emerging markets continues to improve as several countries have shown meaningful progress on debt consolidation, disciplined central bank action, and well-managed inflation through 2025. Turkey, for example, saw continued declines in borrowing costs through the entire year last year, and South Africa received their first ratings upgrade in 2 decades, moving from a BB- to a BB in foreign currency bonds. And turning to Latin American markets, this trend is continuing into 2026. New data from Chile shows inflation coming in lower than December projections, helped both by peso appreciation and softer core goods inflation, supporting the likelihood of a rate cut by the Chilean central bank in March. Similarly, Ecuador issued $4 billion bonds on Monday with strong subscription demand, an encouraging signal after prolonged engagement with IMF stabilization programs. Their successful re-entry into global debt markets creates a positive read-through for countries like Argentina and Brazil, who may soon follow. Overall, when we look across larger countries like Turkey, South Africa, and the entire Latin American complex, the broad EM complex is showing healthier inflation and growth dynamics, which we will continue to monitor as we manage the continued exposure to emerging market credit risk in our broad fixed income portfolios. With that, thank you, and please join us for insights from my colleagues next week and the following week, including hopefully over that time, a new Super Bowl champion for 2026.
Hi, I'm Sophie Antal-Gibert, Head of Portfolio and Business Consulting at Russell Investments. If you liked what you just saw and heard, consider subscribing to our YouTube channel or check us out on LinkedIn. Thanks for tuning in.